Welcome to this explainer. Okay, have you ever wondered why some people just seem to build these massive, multi-generational fortunes, while others treat investing like a trip to the casino and end up losing the whole shebang? Well, today we're going to completely demystify the stock market. We are building a clear, low-stress roadmap to wealth. We're going to talk about how the market actually works behind the scenes, the exact tools you can use to start investing with absolute confidence, even if you only have like 50 or 100 bucks to your name right now, and exactly how to set yourself up for the best possible chances of long-term success.
So, let's dive right into this. Here is our roadmap for today. First, we'll cover exactly why you need to be investing. Second, we're decoding some of that confusing stock market lingo. Third, we'll figure out how to choose your actual investment strategy. And finally, we'll walk through building your very first portfolio. Let's get to it.
All right, Section 1. Why invest in stocks? Simply put, it's time to actually make your money work for you.
Think about it like this. If you leave your cash just sitting idle in a typical big bank savings account, you're probably earning a pitiful, 0.1% interest. It's basically nothing. But there's a much bigger, almost existential threat to your cash, and that is inflation. Now, the U.S. Federal Reserve publicly targets a 2% inflation rate every year just to keep the economy churning. But if you've glanced at the news over the past few years, you know inflation recently hit closer to 5 or even 8%. So what does that mean for us? It means if you aren't earning at least that same percentage back on your money, your savings are actively losing purchasing power every single day. They just sit in the bank.
And this brilliantly illustrates exactly how purchasing power just evaporates over time. Let's talk about the U.S. postage stamp. Back in 1971, it cost just 8 cents to mail a letter. Fast forward to today, and that exact same stamp costs 73 cents. The mechanics of the stamp are literally identical, right? It just gets a standard letter delivered anywhere in the US. But as time has passed, it has gotten wildly more expensive to ship that exact same letter strictly because of inflation. So how do we actually beat this? Well, we invest. Let's talk about the sheer magic, and it literally feels like magic, of compound interest. Let's say you take $5,000 from your savings to make an initial deposit, and then you just consistently invest $1,000 every single month. If we apply the historical average annual return of the stock market, which hovers around 8%, and you let that grow for 30 years, your final balance would be over $1.5 million. No joke. And here's the real kicker. You only put in $365,000 of your own hard-earned money. That means over $1.1 million of that is pure profit. That is the power of compound interest, where the interest you earn on your money starts earning its own interest, just continuously snowballing upon itself.
Moving right along to Section 2, Stock Market Lingo Explained. We've got to learn to speak the language before we jump in.
Okay, so the stock market is basically just a giant digital marketplace for buying and selling small pieces of ownership in companies, right? But you need the vocabulary. Let's start with a total classic, bulls and bears. Being bullish means you have a positive outlook. You expect prices to go up. Being bearish, you expect prices to fall. The absolute easiest way to remember this is that bulls have horns that point up, which is the direction you want your portfolio to go. Bears, on the other hand, have claws that swing downward when they catch their prey. Simple, right?
Another really great term you'll hear thrown around on financial news all the time is frothy. When a market is frothy, prices are inflating and bubbling up to the top. Think of pouring a super highly carbonated drink. The bubbles are exciting, they're rising quickly, but you really don't want the glass to overflow. A frothy market isn't a full-blown bubble just yet, but it's getting dangerously close to one. It's a lot like the dot-com era in the year 2000, where stocks traded at these ridiculous valuations right before the bubble finally burst.
Then we have the blue chip stock. We are talking about excellent, highly valuable, and incredibly stable companies here. Think of your heavy hitters like Apple, Coca-Cola, or McDonald's. Interestingly enough, this term actually originated from poker games way back in the 1920s, where the blue chips were the absolute most valuable $200 chips on the table. And this is the exact opposite of what we call a penny stock. Penny stocks are very small, highly speculative companies that literally often cost pennies, but they carry an incredibly high risk of just going straight to zero.
Now let's break down market capitalization, or market cap for short. This is basically how we categorize the total size and valuation of a company. As we move up the ladder from micro caps at under $300 million all the way up to large caps sitting at over $10 billion, the absolute crucial takeaway for beginners here is the risk profile. Microcaps are incredibly volatile. Sure, they have massive room to grow, but they also have a super high chance of failing. Large caps, like our blue chips, offer much more stability, though their future growth might be a bit slower simply because they're already so massive.
All right, Section 3, choosing your investment strategy.
Let's find the path that actually makes sense for you. As a beginner, honestly, the worst thing you can do is attempt to day trade or chase after those quick, volatile returns. Instead, you've got a major choice to make. Are you picking individual stocks, or are you buying into index funds? Picking individual stocks is super tempting, but it requires deep fundamental research and a lot of conviction. Look at the tech company Intel, for example. They were this high-flying stock during the dot-com bubble in the year 2000. But if you bought them at their peak back then, you actually still wouldn't have broken even today. Crazy, right? Meanwhile, the broader market has grown tremendously, and that's exactly why index funds are so powerful for beginners. An index fund, like one tracking the S&P 500, just passively buys the top 500 US companies all at once. You get instant diversification, and you can rely on that historical average return of 8 to 10% without the stress of having to pick one specific winner.
But hey, if you do want to evaluate individual stocks, you absolutely need to understand the PE ratio, which stands for price to earnings. This metric tells you exactly how many dollars investors are currently willing to pay for every single dollar of that company's profit. To put that into perspective, Apple recently had a PE ratio of around 38, while Nvidia was trading way up around 53. A higher ratio, like Nvidia's, suggests that the market is eagerly pricing in some massive future growth and innovation expectations. It's a fantastic tool, but always remember to compare a company's PE ratio strictly to other companies within the exact same industry.
Ultimately, whether you decide to buy individual stocks or stick to index funds, the most critical strategy is just consistency. This quote right here from the financial blog Dollars and Data really hits the nail on the head. Rather than worry about whether now is the right time to buy, just keep buying. The data flat out shows that trying to time the market is a fool's errand. Seriously, if you search Google back in 2012, there were tons of articles claiming the stock market was heavily overvalued when the S&P 500 was sitting at just 1,400. If you got scared and waited on the sidelines, you would have missed out big time as the index climbed towards 6,000 in the years that followed. Historically, over any 20 to 30-year period, U.S. stocks have shown virtually zero real negative returns. So whether the market is up or down, just keep buying. Okay, home stretch. Section 4. Building your first portfolio. Let's translate all this into a step-by-step action plan.
Getting started actually only requires 3 main steps. Step 1, you have to open a special account. You can't just buy stocks directly out of your normal checking account. You need a dedicated brokerage account like M1 Finance, Fidelity, or Robinhood, or a retirement account. Step 2, you choose your assets. That means deciding between those individual stocks we talked about or broadly diversified index funds. And step 3, set up a system to invest consistently over time so you can leverage that massive compound interest we broke down earlier.
So the crucial point here is choosing the right account to minimize your tax burden. And the absolute best tool for this is the Roth IRA. If you take away only one thing from this entire explainer, let it be this: open a Roth IRA. You fund this account with after-tax dollars, and right now the contribution limit is $7,000 a year. But here's where it gets insane. Any money you make inside that account, even if it grows into millions and millions of dollars over the next 50 years, is completely 100% tax-free when you finally take it out in retirement. It is literally the ultimate wealth-building cheat code.
And if you want the ultimate zero-stress, set-it-and-forget-it strategy to put inside that shiny new Roth IRA, look no further than the 3-fund portfolio. This strategy takes your money and splits it across just 3 broad index funds. You put 60% in total U.S. stocks, 30% in international stocks, and 10% in bonds. This beautifully simple allocation gives you massive global diversification, keeps your account fees incredibly low, and is completely designed to weather almost any market condition without you ever having to sit there and micromanage it.
Now, what if you're trading in a standard, taxable brokerage account instead of a Roth IRA? Well, then you got to understand taxes. You only actually owe taxes when you sell a stock and lock in or realize a profit. If you hold a stock for less than a year before you sell it, that's a short-term capital gain, and that gets taxed at your ordinary income rate, which could be upwards of 35%. Ouch. But if you simply hold on to that stock for over a year, it magically becomes a long-term capital gain, which is taxed at roughly half that rate, usually sitting around 15 to 20%. You can even get into advanced strategies like tax loss harvesting, which basically means selling your losing stocks to offset the taxes you owe on your winners. But as a general rule of thumb, don't let the fear of taxes stop you from taking a really solid profit.
We've covered a tremendous amount of ground today, all the way from the jaw-dropping power of compound interest to the incredible tax cheat code that is a Roth IRA. But the absolute bottom line is this: every single day your cash just sits idle in a bank. Inflation is out there actively eating away its value. You now have the vocabulary, the strategies, and the concrete roadmap to stop that from happening. You don't have to be some fancy Wall Street insider to build real wealth. You just have to get started and be consistent. So knowing that every single day you wait is literally costing you money, what is the very first thing you are going to invest in today? Get out there, open that account, and start making your money work for you. Thanks so much for joining me on this explainer, and happy investing.